Hi students, how are you? In today's session, we are going to see provisions and contingent liabilities and contingent assets. Sri Lankan Accounting Standards number 37 and International Accounting Standards number 37. Right? Uh, this provision in the provision, if you say one by one, what is the provision? Provision is the liability, right? Provision is a liability with the uncertain amount and time. With uncertain amount or time, right? For an example, we have given out debt for a person, right? So we will say we are lenders, right? We are lenders and we have given out debts and so many people borrowed money from us. Out of 5 or 6 people, 1 or 2 people may default the payment, right? So default the payment in the sense not hold the payment, maybe part of the payment or hold the payment. So we cannot predict it, we cannot assess it, right? So it is uncertain, they may pay or they may not pay, right? We have identified few people. In such case, they may not pay or others are okay. Few people are not paying. So we cannot evaluate whether they may pay full amount or part amount. So that is the situation, is provision we have to make. We have to make a provision. That is why provision for debtors, right? That is the example for provision for debtors. So provision, liability and uncertain amount or time. Recognize in profit and loss, right? The assessed amount, you have to recognize it in the profit and loss account as an expense, and you have to credit it to the provision account. Particular provision account has to be credited and a debit should go to the particular provision account, and expense account, right? So that is why provision can be defined as a present obligation of a present obligation that has arisen due to past event or activity. Present obligation, there should be a present obligation as a result of a past event or activity. So that means present obligation because of, as a result of past event or activity. That's all. We have lended money to people, 5 people, right? We have done a past activity. There's a activity, right? A, right? A lends money to B, C, D, and E, right? But he's little bit doubt about the E, whether he will pay or not, and whether he will pay or not, and whether he will pay full amount or not, because he has already lended the money to these people. This is the past activity. Lended the money is a past activity. He already given money out of his pocket. That's a past activity. Because of that only this situation has arisen. The obligation has arisen. That's what he got the present obligation, right? That is the reason. That is what they said. Present obligation in the sense as a result of a past event. That may be a legal or constructive. Legal means by way of as per the legislation, right? Or legislation means legal framework. Under the legal framework, it is guaranteed as per the legal framework. And if you have given money on the basis of debt, it is under the legal terms you have to return back the original money. You have to return back. That is a legal framework. Or this is constructive activity. Constructive way, by way of constructive activities. Constructive activities in the sense that is by way of behavior, right? By way of your past behavior, past attitude, right? The way of you behave, right? That is a constructive activities. Or you would have orally disclosed, you have promised him. That is also under constructive, right? Or past activities. That is meant by constructive, legal or constructive. That present obligation may be either legal or constructive, right? And probable transfer of outflow or economic benefit. Probable, there is a probability of transfer of the economic benefit transfer from him. The economic benefit is transferred from him to other person. That is 50%. 50%, that should be the 50%. The economic benefit should be the 50%, right? Okay. Or measure the outcome reliably, and you should be able to measure the outcome reliably. That is the provision, right? You can measure it reliably, half or 50% or 100,000. Before above that you won't go. That is what measurement. Measure the outcome reliably. Okay, that means you are measuring the, that means you have given out money 100 rupees to him in the sense E. You can measure the outcome reliably. Outcome is he won't return back because he is under the, you may say he may be bankrupt, right? So reliably you can come for a conclusion, measure the outcome that is default, right? So probable transfer of our economic benefit should be more than 50%, right? If it is more than 50% only, you have to make an arrangement, right? You have to make a entries. Vice versa, if you say this one, if you have all these three is satisfied only, you are making the provision. If all the three conditions, that is present obligation as a result of a past event and probable transfer of the economic benefit, right? And economic, you can reliably estimate the outcome, right? Measure the outcome. All these three conditions satisfied only, you will make the provision. If all these three situations are not met, we will see later, right? Subsequent treatment. Review the provision annually. Only use the provision for expense originally created, right? Originally you have to review the provision annually. Only use the provision for expense originally created. Only use the provision for expenses originally created. Second one is contingent liability. We have seen what is provision for provision. Now we will see contingent liability. Contingent liability is possible obligation. Possible obligation is not present existing but possible obligation. In the provision we have seen present obligation is there, but here obligation is possible, and present obligation possible transfer or cannot measure the reliability. Reliable cannot measure the reliability amount, right? You cannot measure. If that in vice versa, if we say if these three conditions are not met, means that is a contingent liability. Contingent liability is vice versa of the provision. For the contingent liability, you won't make any adjustments in the accounts. You won't pass any double entry. You have to do the disclosure only. That is what they said. Specific contingent may be liability, may be specific future operation, right? Maybe for few some specific cases are there. In that we say specific future operating losses, no provision made, no obligation, right? Future losses. For the future losses, you cannot make a provision because there is no obligation, right? There is no obligation, right? And onerous contracts, provision recognized lower of present value of continuing under the contract or present value of the existing the contract, existing the contract, right? These whichever is lower, you have to take the whichever is the lower. That's onerous contract in the sense you have entered into the contract where the cost is cost incurred in that contract is more than the economic benefits received from that specific contract. In that case, in other case, you will say loss. In other term, right? That is meant by the onerous contract, right? So in onerous contracts, provision recognized, right? Provision is recognized at lower of present value of the continuing under the contract or present value of the existing the contract. Other thing is restructuring. Restructuring the company. Restructuring the company in the sense you are abandoning the specific activities in your branches or sale or closure of a line in the business, sale or closure of your one of your lines in the business factory, ceasing activities in a geographical location, ceasing the activities in a geographical location. That may be you may have some sort of productions island wide or your country wide, right? You may cease one of the locations activities due to some reason, right? Maybe expenses are higher or the transportation costs problem, maybe due to that or sometimes maybe the competitors, right? So you may cease activities in a geographic location. And relocating activities also may take place from one location to transfer your facilities to the another location in your country. And reorganization, right? Reorganization of the management or focus on the operation, that also comes under the restructuring. Okay, restructure. And provision is recognized if there is a detailed formal plan and the plan has been announced. Provision for these activities, restructuring, right? For the restructuring of a company, you can make a provision as per the this accounting standards. Provision is recognized if there is a detailed formal plan and the plan has been announced. You should have a formal plan and you should have announced the formal plan, right? In that case only. In that case also, there is a subdivision is there. The provision should only include costs which are necessarily be incurred. The incurring cost for these activities should have been necessarily be incurred and not associated with the continuing activity. The cost has to be segregated from the continuing activities, right? For the restructuring activities, only the costs related to the restructuring necessarily in connected with the restructuring activity, and continuing operation with the cost associated with the continuing activity should not be included in this calculation. Contingent assets are vice versa of the contingent liability, opposite of the contingent liability, right? So we will move into the question. Okay. The what you call measurement is, right? Measurement should be, right? Measurement should be one. Sorry, best estimate of expenditure. Best estimate of expenditure. Expenditure. Okay. Use. That is different outcomes, right? Different outcomes. Discount to the present value if material. Discount to present value if material, right? The measurement should be best estimate of expenditure, right? Measurement should be best estimate of the expenditure, right? You should correctly estimate the cost to be provision, right? Expected values, that is various values may be there. Maybe if you say for a debtor of 5,000, so expected variable level means he may not pay whole amount. May not pay, may not pay whole amount, or he may not pay half of it, right? Or he may not pay whole amount, right? There are expected outcomes are there. 3 outcomes are there for this particular activity, right? That's what they say, expected value, the correct expected value, right? Possible expected value. And this is repayable after 2 years, in the sense discounted to, we have to discount for these are small amounts. These amounts no need to be discounted. If you say this is 5,000 million or 5 million, of 500 million, then it has to be discounted to the present value to show in your accounts. That's what they say, discounted present value if material. If the amount is material, you have to discount it to the present value. That is the important clause here, right? Best estimate of expenditure, expected value, that means various level of values, outcomes, various outcomes would be there. Discount to the present value if material. Okay, I am raising this one, take down it. This is measurement, right? So now we move into the questions. By doing the questions, we can get a, you can get a good uh, picture on this, right? So number one, following the explosion, explosion of an oil rig in the North Sea that resulted in large amounts of environmental damage, the company was taken to court by the local authority who were looking to recover the cost of the cleanup operation, right? Cleanup operation, that means they have entered into the, they have done the oil explosion blast, right? Due to that activities, environment got damaged, so environmental authority decided to recover the cleanup operation, right? The company has been informed by their lawyers, that company has been informed by their lawyers that it was probable that they would be liable for the cost of the cleanup operations, right? They would be liable for the cost of cleanup operations. The lawyers estimated that following financial settlements uh, and their likelihood, right? They say they say settlement amount, right? Settlement likelihood percentage, right? Settlement amount and likelihood, right? Likelihood of settlement, right? So here this is for 45 million, 45 million, the percentage is 20%, 20%, right? For the 60 million, it is 45 percentage, 45 percentage, right? For the 85 million, it is how many? 35%, 35 percentage, right? So for a single obligation that is being measured, right? This is they want to know what is our obligation. This is one single obligation. For single obligation, we have three outcomes, right? The lawyers have given, advised us with the three outcomes. Those three outcomes, probable outcomes, that is, we may have to pay 45 million in the cost for 20%. The possibility is 20%, 45 million. Paying 60 million, possibility is 45 percentage. For the 85 million, percentage is 35%. But here our obligation is actually not whole percentage. This 60 million is our obligation, because anything beyond 50% we have to pass and do a double entry in our accounts. But since it is closer to 50%, 40 50%, we can make a what you call double entry, and we can show this as an, we can make a provision and write it off in the P&L for damages paid, right? This is the damages paid, right? Damages paid for the destructing the environment, right? So 60 million we can make a provision, right? That 45 percentage probability is there. And some of the guys used to make average of these three. No, that is wrong. There only you make the mistake. There is no talk about the average, right? Here we have seen, you can see provision, present obligation as a result of a past event, right? It is the past event. Here past event is the past event in this scenario is the, we have, right, we have did the explosion of an oil rig, right? That is a past event. So past event is there. Probable transfer of outflow of economic benefit. Yes, there is a probable transfer of economic benefit. That is, economic benefit is going to transfer here 45 million or 60 million or 55 million. Measure the outcome reliably. Yes, our three outcomes are there. We can measure it. So now we can have a provision for this one. We can make a provision for this one. So 60 million, 45 percentage probability is there. So we can pass, we can show this in our accounts. Statement of financial position, we can show this as a provision in the liabilities, right? And we, in the statement of profit and loss account, we can write it off as a damages. Okay. Okay. So that is finished. Next illustration is, right, a company. I will raise it down. Right. Second one is, right, a company sells second-hand cars with 6-month warranty. A company sells cars with 6-month warranty that promises to repair the cars if any faults occur following the sale. Subsequent to the sale, if there is any damages take place or any fault take place, the company will do the repairs. The following has estimated that 80% of the cars sold last 6 months will require no repairs. 80% of the cars sold no repairs. No repairs, right? Okay, right, 80%, right? The However, 50% will require minor repairs, right? 50%, 15% require minor repairs. Right? And 5% will require major repairs. 5% require major repairs, right? Then the company has estimated that if all the cars were will have to minor repairs, then if this is all the cars are minor repairs, in the sense how much we have to allocate the cost. Minor repairs, this is minor repairs, right? 100,000, we need the 100,000 for the provision, right? 100,000 we have to make a provision. And if the all the cars will have to major repairs, then this would be 500,000. 500,000, right? If we need a major repair for all the cars, that means 100%, 500,000, right? For large population of items, right? This is the large population of items, right? So they wanted to know what is the provision we have to make. What is the provision we have to make? This is for the provision for the 100 percentage. This is for the 100 percentage. This is for the 100 percentage. Of 80% will not have any repairs. No repairs. Nil. Right? Nil. So we need minor repairs. For minor repairs, minor repairs, right? Repairs. We say 100,000, right? 100,000 into, right? 100,000 into 15 percentage, right? That is how much? 15,000, right? And major repairs take 500,000 into 5 percentage, right? 500,000 into 5 percentage, right? That is 25,000. 25. Total you had to make 40,000. Provision has to make for 40,000, right? This is called a warranty. Sales after the services, right? 2 years warranty or 6 months warranty we have given out, right? So we have given a warranty, right? So during the 6 months, if there is any minor repairs or major repairs takes place, the company will undertake all the cost of repairs, right? So the company has a past activity. That means constructive activity. That means 80% of the sales do not come back to the repairs. 15% of the sales come back to the minor repairs. 5% of the sales out of 100 come to the major repairs. So due to this past analyzation, the company can make a provision on 15% and 5%. 15% on minor repairs and 5% for the major repairs. This is the provision we have to make. In the sales income, we can make a provision of 15,000, 40,000, 15 and 25, 40,000, right? So that is the right? That is the answer, and I am going to raise it, right? And we'll go for the third one. Okay, go for the third question. Third question, question number 3, discounting the provision, right? Harmer's company has a year end of 31st December 2018, right? 2018, year end of December 2018, right? 31st December 2018, right? And it was notified that on the 1st of July 2018, right, former employee brought a legal claim for unfair dismissal, right? HR company's legal team have said that it is probable that the company loses the case, resulting in a payment of 495,000 on 30th June 2019. So the company's cost of capital 10% per annum. A 1 year discounted factor at 10% is 0.9091, right? So we will say 1st of July, 1st of July, okay, July, the 400, the action is filed, action filed, right? We are closing the accounts on 31st July 2023, sorry, July 2018, right? 31st December 2018, we are closing the accounts, and July 31st of July or 1st of July, 1st of July 2019, we have to pay 495,000. We have to pay 495,000, right? 495,000, right? We are told 495,000 is payable in 2029. So we had to discount the value, right? We had to discount the value. That means discount to present value, right? That is 495,000 into 0.9091 is the table, right? Discounting factor, right? So closest amount is 450,000, 450,000, right? 450,000 we have to pay. This is the present value, right? But they have mentioned, right? They have mentioned there is a 10 percentage of capital per annum. 10 percentage of capital annum. So we have to say finance cost, or we can say unwound, right? Unwind, right? Unwind discount, right? This is called unwind discount. Discount is 450,000 into 10 percentage into 6 into 12. That is 6 months, right? This is 6 months. 6 months, okay, 6 months. This is 1 year. 1 year, right? As at 31st December only we are making the accounts, right? So this is amounted to, right, 22,500. 22,500. That means 450,000 and 22,500. So 472,000 comes, right? Total provision is 472,000 we had to make, right? We had to show it in the statement of profit and loss account, right? Statement of financial position, statement of financial position, and statement of profit and loss, right? Before that we have to do the calculation, double entry, right? We have to say debit to profit and loss account. Profit and loss account, how much? 450,000. Credit provision, credit provision, right? Then we will say how much? 450,000 472,000 as a, what you call, as a provision, right? Here you will get to know staff cost, legal cost. Of staff cost you can say 450,000 in profit and loss, and 22,500, 22,500 you will say finance cost, cost, okay? This is the entry you had to make in statement of profit and loss account and statement of financial accounts. This is the amount you had to show, okay? So we will, this is the number 3, and we will move to the number 4 accounts, okay? Have you understood? I think this simple way I have taught you in simple way. Otherwise we can say initial recognition is 450, right? initial, this is separate, right, initial recognition. So initial initial recognition is 495,000 into 0.9091, right, that is 450,000, right. Recognition of unwound cost, recognition of unwound cost, that is 22,500. Total is 472,500. This is the amount you have to show in the financial position. Okay, so we will go to the next question. One is, right, fourth question is a provision of 10 million was correctly provided for the financial statements in the prior year based upon the information held at the reporting date. At the end of the current year, the provision was settled for 12 million, right? Provision made for 10 million, provision settled for 12 million. The difference is 2 million. 2 million has to be charged to the PNL, right? PNL, charged to the PNL, right? Current year, the provision was settled for 12 million in cash. So the payment of the 12 million cash would reduce the provision down to zero, create an additional expenses of 2 million, right? In profit and loss account, administrative expenses, we had to show this 2 million in the administrative expenses, right? This is not a big task, right? And second one is, because already 10 million had been made as a provision, right? Provision account, provision account already carried down value would be there 10 million, but during the year cash account we have settled 12 million, right? Provision, right? 12 million, go to the provision account, 12 million cash. Excess 2 million has to be charged to the PNL. Okay, PNL and provision account credit, PNL account debit. Okay, that is the double entry you have to make for this particular transaction. That next one is fifth one. Okay, fifth one, another contingent liability. We will say, the question says the following items have to be considered when finalizing the financial statements of G Star company limited liability company, right? The company gives warranties on its products, right? Company gives warranty, right? Warranties. The company gives the warranties to the customers, right? Products, for its products. The company satisfies, the company statistics show that about 5% of the sales give rise to warranty claim. Only the 5% claims the warranty, right? The company has guaranteed the overdraft of what is the correct action to take in the financial statement for these items. Item 1, warranties. No, warranties. For warranties you have to create a provision, create the provision, right? For the warranties, create a provision. Second one is the company has guaranteed the overdraft of another company, right? The likelihood of liability arising under the guarantees is assessed as possible. It is assessed as possible because we don't know exact amount, and assessed as possible means obligation is assessed as possible. Then you have to make a disclosure because it is contingent liability. Disclosure with with notes, not right, because if it is for the possible obligation, then contingent liability, it should have been shown as a contingent liability. If it is a present obligation is available as a result of the past event, then it is a provision. So this is a contingent liability, right? This is a contingent liability. This is a warranties. There is a possibility. There is a past event, right? So this should have been treated as a provision. Provision. This is a contingent liability. Contingent liability, right? So sixth one, the provision and contingencies. The provision and contingencies. Okay. Justina supplies fish, right? Justina supplies fish to a local restaurant in August 2009. She supplied the restaurant with some supplied a restaurant with some shellfish, and now she has heard some of the restaurant's customers have suffered attacks of food poisoning. So the restaurant has claimed that this is because of Justina's shellfish, right, and has commenced a legal action against her, right? They have started a legal action against the person. A local solicitor who specializes in food poisoning cases has advised that the owner should has to has a 42% chance of losing the case, and if she does lose, she will probably have to pay 300,000 to settle the liability. What is the nature of the Janada's liability, if any, and how should it to be treated in a financial statement? This is actually she has supplied fish to the restaurant and customers suffered food poisoning, and the restaurant sued the owner, right? Owner. But there is a 42 percentage of possibility of making the what you call compensation, right? So legal action will lose the legal action 40 to 42% on. If she has lost, she has to pay 300,000. 300,000. But since this percentage is below the 50% norm, the disclosure only required. No need to make a provision. No need to make a provision. Therefore, disclosure is more than enough, right? So, sixth one is finished. Small issues you can learn about it. 7. Number 7. Onerous contract, right? Deva has a contract to buy 900 meters of cloth each month for 7 per meter. From each 3 meters of cloth, he can make dress which he can sell for $30. He incurs a labor cost of 4 rupees per dress. Alternatively, he can sell the cloth immediately for 6.25 per meter. If he decides to cancel the cloth purchase contract without notice, he must pay a cancellation penalty of $700, 700 rupees for each of the next 2 months. In December 2019, the market price of dress fell down to 22. He considering ceasing production since he believes that the market will not improve. There is 2 months notice stated in the contract in case of breach of a contract. Is there a present obligation? What will appear in respect of the contract or Deva's financial statements for the year ended? Okay, this is the question, right? To if he want to exceed the contract, right? This is this is uh, this is the specific contract. It is coming under the specific contract, that's onerous contract, right? Onerous contract. Another onerous contract provision recognized lower of present value of continuing under the contract, or present value is if you want to continue the contract, what is the present value of the continuation of the contract? Or if you want to exit the contract, what is the present value of the cost of the exiting the contract? That is what we are saying. Present value of exiting, cost of exiting. If you want to exit the contract, right? If you want to exit the contract, you had to pay, right? 2 months, 2 months, 2 months at the rate of 700 penalty fees. That is 1,400. Okay, 1,400. If we want to continue the contract, if we want to continue the contract, right? He can continue in 2 ways. One is stitching, right? Making the clothes, right? Making dress. dress, right? Second one is reselling the cloth, reselling cloth, right? Exit, he has three type of outcomes. One is exiting the contract, or making dress, or reselling the cloth. If he want to exit the contract, he has to pay suffer 1,400. If he want to make the make the dress, what is the cost of dress, right? If you want to make the dress, 900 meters of cloth, right? 900 meters of cloth divided by 3 meters, right? 900 meters, 900 meters divided by 3, then 300 dresses, right? No, labor also there, na? 300 dresses, right? 300 dresses. They have to make labor. Labor is how much? 4 per dress, right? 300 dresses. Labor is 4 rupees per unit, right? Then 4 into 300, it is how much? 4 into 4 per dress alternately. 1,200, right? Labor cost is 1,200, right? 1,200, right? 1,200, right? This is equal to 1,200 into 2 months. That is 2,400. 2,400, right? 2,400. Dresses, 300 dress per month, then 600 dresses. Selling price, cost of material is 900 into 2 into 7, right? That is $7. 12,600. That is 12,600, right? Then you will arrive at selling price, right? 12,600. Then cost is 15,000. Then revenue is 300 into how much is the 22 rupees. 300 into 22, that is how much? 13,200. 13,200, right? From 13,200 you have to deduct 15,000, then 1,800, right? 1 minus 2, right? This 1,800 is a loss if we make the dress. If we reselling means material is 12,000, that is 9,900 into 2 into, so that is 12,600. If we sell it, selling price is 625, then 900 revenue, 900 into 2 into 6.25, that is 11,250. 11,250, then 350 is the loss, right? Loss. They says present value of continuing under taking of the contract, or present value of the exiting the contract, right? It is the option of reselling the material is the correct one. This is the correct one. Here only we will suffer a lower loss of 350, here loss of 1,300, here loss of 1,400 if we discontinue, right? So we have to adopt the reselling of the without exiting the contract of purchasing the clothes, purchase the clothes and resell it, and thereby you can minimize your loss. You can minimize the loss. If you are incurring the loss, in the sense you try to minimize the loss, future losses, you have to minimize the loss, right? Rather than discontinuing the operation, you have to see whether if you what is the cost involved in if you discontinue the operation, if you exit the contract. If you exit the contract, cost is 1,400, is the loss, right? If you make and do the business, making dressing business, you will incur a loss of 1,800, right? If when you compare this and this is exiting contract is good, but another option also there, reselling the cloth at the rate of 6.25, then you will suffer a loss of 350, right? Then buy and sell it, resell it, that is the correct option. This is the option you have to choose. This option you have to choose. This is the option. Select this option. This option, right? Okay. So this is the answer for question number 7, and question number 8 we will see. In the question number 8, I am raising this one. Okay. $350 is the loss provision. You have to make a 350 provision, right? Okay. In the question number 8, right? Question number 8. Next question. On August 18th, right? 18th August 2017, the director of P decided to close the candy factory, right? Candy factory. They want to close the candy factory. That means restructuring. Now question is in the restructuring. Restructuring in the sense we have seen in the restructuring sale or closure of line of business. That also should be provision is recognized if there is a detailed format of plan, right? So we would see, assuming that no steps were taken to implement the decision and the decision was not communicated to any of those affected by the statement of financial position date of 31st August 2017. What is the appropriate accounting treatment? Right? What is the appropriate accounting treatment? Right? Restructuring. Right? No provision is made. No provision. For A, there is no provision. No provision. No provision. No, there is no, the provision say provision is recognized the, this thing is, they should only include the cost with the all the necessities and incurred and not associated with the continuing actions, and they have to inform all the people that they have a detailed report, right? Formal report. Provision is recognized if there is a detailed formal plan. The plan has been announced. The plan has to be announced. They have not done so. So that is no provision, right? What would be the appropriate accounting treatment for the closure of a closure if a detailed plan had been agreed by the board on 26th August 2017 and later sent to notify suppliers? The workforce in Candy has been sent redundancy notice. The laborers have been sent back. So all the actions has been taken and it has been informed. Then make a provision. B, make provision. Right? Make a provision. Okay. And next one is contingent asset. That in the contingent asset, right? We have seen contingent asset. I'm going to raise it. Contingent asset, right? This is contingent asset if it is remote, right? Remote or possible, ignore, no, right? Second one is obligation, probable and virtual. Probable, provision. Virtual, virtual, virtually certain, right? Virtually, if it is certain. Contingent asset. Contingent asset, right? Provision also disclose. Okay. 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 Next one is Next one is contingent assets, right? In the contingent assets, right? First one is we know remote, or possible, right? Remote or possible. Second is remote or possible, and remote or possible, probable, virtual, right? In before seeing it, in the contingent assets can be remote or possible, remote or possible, and probable, and virtually confirmed, na? Virtually confirmed, certain, right? If it is remote and possible, right? If it is possible remote, ignore, right? If it is probable, disclose, right? If it is probable, disclose. If it is virtual, it is confirm as a contingent asset. Not contingent, asset, right? Okay, we don't mention contingent word in the financial statement. Okay, so if it is possible, probable, disclose. Possible in the sense totally ignore. Virtually certain in the sense if it is certain, make it as an asset. We will see the example question, right? A business has a reporting date of 31st December and inventory worth of 100,000, right? On 31st December, right, they had inventory worth of 100,000. Inventory, right? This is inventory. This is equally virtually certain in the sense if the company say the insurance, the good example is virtually certain is in the sense insurance. If insurance company confirms you the payment, it is the asset. You have to insurance receivable. You have to say mention it as an asset, right? So 31st December inventory is 100,000 was stolen just prior to the reporting date. Stolen, right? Stolen just prior to the reporting date, right? The business has made a claim on its insurance and has heard from the insurance who have said it is probable, right? They said it is probable. Insurance, they said, informed you it is probable to get the whole 100,000 as an insurance, right? But after saying that, the insurance who have said that it is probable that the full payment will be reimbursed, but no further confirmation of when any payment will be made has been received. No further confirmation received from the insurance. No further confirmation was received from the insurance or payments received, right? So there is, it is a probable, so disclose, so disclose, right? If it is, if probable in the sense only, we said it is disclose it in the financial state, right? If the insurance had confirmed, if insurance confirmed, if insurance confirmed it, that subsequently if insurance confirm it, right, then you had to show it as an asset. You had to show it as the insurance receivable as an asset under the current asset receivable. Right? This is what you had to learn from contingent assets. We don't say contingent asset. We used to say asset in the financial statement. You don't say contingent receivable of insurance. No, receivable insurance. Right? So you must know the difference between the possible, probable, possible, and virtual certain. This is virtually certain. Subsequently, if insurance confirmed it, that is virtually confirmed. And if they pay a part payment, it is confirmed, right? Then we have to make show it as asset. If they say probably you can take, we can pay you, probably we can pay you the whole amount in the sense, no, right? There is no conformity. If they stay with that without no further information in the sense, it is probable. Okay. Okay. So I think I am going to conclude the provisions, contingent liability, and contingent assets. Right. We have seen the whole. We have gone through the whole accounting standards and all the probable uh, probability of questions we have discussed, and with this today we are concluding these lectures, and I hope to meet you in next lectures. Okay, thank you, take care.